Reporting here. So
Uh,
everything that we've been talking about, bonds, stocks, mutual funds, CDs, right? All these are different types of investments. But the question we have to ask ourselves is, how do we want to invest? And what a big portion of that decision really has to do with taxes, right? And what I mean by tax sheltering is I want to pay as little taxes as possible. When I make a investment of $100 and say I get a 50% return, right? So now I've got $150. I still have to pay taxes on that of about 10%, right? So 10% of that $50. So really my return is only 140, is only 40%. Does that math make sense? Right. So I want to make sure that I'm not and 50% is like pretty awesome, right? But if you're getting a 10% return, but you're also paying 10% or 10% in taxes, my friend, you're not really winning here, right? So the idea is, how do I invest in a way where I'm managing my tax liability? Yeah. And all props to Samantha. So Samantha is a personal financial planner based out of here in Alameda. And she came to my class in the fall and spoke to the class. And I've never seen it laid out this simply before. And so I'm just like I'm stealing like her work because I thought it was so clearly laid out. And she wanted to come this semester, but well, it was before everything else happened. But with tax season and all this other stuff, she just couldn't find the time. But anyway, she put investment into 3 boxes. Okay? So the first box is you make investments, you contribute into these investment vehicles pre-tax. So in other words, you don't have to pay taxes on the money before you invest it. So I earn $100. If I put $100 into this box, I don't have to pay the government anything. Okay. These next 2 are after taxes. Okay, so if I invest in any one of these boxes, okay, I make $100, I first have to pay the government, let's say 20% is my tax rate. I have to give them $20 for taxes, and then I've got $80 to put into one of these buckets. Okay. The other thing to keep in mind is so when I'm taking money out, if I take money out of this bucket, I'm taking money out tax-free. Okay. So anything that comes out of this bucket is tax-free. So going back to me making $50 on my investment, if it was in this box, I get to keep $50. Okay. If I'm making money taking it out of here, right, then I made $50, but I'm paying taxes on based on my ordinary, as if it was ordinary income, right? So my tax rate of 20% in this example. And if it's out of this bucket, my distributions I'm being taxed as not on gains, but I'm being taxed on my gains. Okay, so I'm paying 10%, 10 or 15%, whatever the tax rate is for the taxes. Okay. So something to keep in mind, right? We're talking about managing our tax liability. Okay. This bucket here, I'm paying taxes before the money comes in, and I'm paying taxes when the money comes out. Okay. So ideally, I want to be in this bucket or this bucket. Okay. What determines it is you have to think about so remember, it's a progressive tax system, right? So the more money you make, the more you get taxed, right? So what's my tax rate right now? In other words, what's my income right now? If I expect my income to be higher 20 years from now, which means my tax rate is going to be higher, then I'd rather pay now at 20% and be able to take out tax-free and avoid paying 25%. Whereas here, I can avoid paying 20%, but when it comes out, I'll have to pay 25%. Or maybe we get some liberal kook in office who says no more taxes, right? So then it's like, oh, great, pre-tax post. Never going to happen, guys. But these are you're looking at all those considerations. Okay, so let's see what goes in. I'm sorry. Yeah, let's see what goes in these boxes, and then I'll let you ask questions. Okay. So 401k, okay, that's pre-tax, taxes ordinary income. IRAs, individual retirement accounts, 403Bs, and SEP IRAs, self-employed IRAs. Okay. These are all pre-tax. You can make contributions into these accounts pre-tax. And then when you take it out, it gets taxed as ordinary income. Now, let me again be clear. Okay? If you're invested in a 401k, when you put, I said it wrong. When you put money in the 401k, then you have to decide, am I going to invest that money in stocks, bonds, mutual funds? Am I just going to leave it in cash? Okay. So 401k is not an investment, right? It's just it's an account that's offering you some tax benefits to it. Same thing with the IRAs, the 403Bs. Okay. Here, after tax, tax-free, great option for those of you who are younger and your tax rate is not as high. Roth IRAs, 529 plan, 401k, a Roth 401k, and a life insurance retirement plan. Or is it long-term investment retirement plan? Life investment retirement plan. The RP is retirement plan. And then you've got your after tax. Okay. So this is everything else. So your Robinhood account, your Fidelity account, just all your regular brokerage accounts. Okay. You're contributing money after that it's been taxed, and you're getting taxed on the gain. Okay. Real estate, your bank accounts, money that goes into your bank accounts sit there as well. So let me pause here and see what questions you have. I'm going to talk about some of these in more detail, but I first just want to pause and check the room and see what questions you have.
Can't you also be taxed on the 401k if you take it out earlier?
Yes, we're going to get into the detail about that. But yes, there's a penalty if you take it out early.
So for the 403 or 401k, is it ordinary tax when you retire, or that's only if you take it out early?
Whenever you take it out, you're going to be taxed on it. If you take it out, if you take it out before you retire, you're going to be taxed on it, and you could be subject to a penalty.
Okay, so you get ordinary income tax after you get your money. Like, let's say you're 65, you're getting your check, then you report that as income?
Yes.
Okay.
Other questions? So again, I'll reiterate, you can put your money in any one of these accounts. Okay? But once you put your money in these accounts, then you still have to make the decision, what do I want to invest in? Okay. Back to the example we were doing with Kylie. Do I just want a 5% return, or do I want a 7% return? Or can I do a 3% return, right? That's going to dictate, am I in conservative bonds? Am I in municipal bonds? Am I in mutual funds, large growth mutual funds? Am I in mid-cap, aggressive funds? But whichever one you choose, you're just investing through here and benefiting from the tax implications of it. Okay, or you're here and you're not benefiting from the tax implications. So 401k. Okay, so 401k, this is an account that's offered through your employer. Okay, so if you have your employer may offer a 401k, and what it does is it allows you to contribute a part of your income before it gets taxed. Okay. So in other words, when you're figuring out how much you owe in taxes, and say you made $50,000 that year, but if you contributed $10,000 to your retirement account through your 401k, you're only going to be taxed on $40,000. You won't be taxed on that additional $10,000. Now, there are some restrictions to it. Because it's for an investment, or I'm sorry, because it's for retirement, that's the reason why they gave you this tax deferral. So once you put the money in, you can't touch it until you're 59 and a half years old. That's the rules right now. Okay. You have to be 59 and a half years old. Okay. If you withdraw the money before then, you're going to have to pay your taxes, Laura. That's what we're talking about. You still have to pay your taxes as ordinary income. Plus, they're going to charge you a 10% penalty. Okay. So you want to be mindful of money you're putting there, because that's money that you're not planning to touch to your age 59 and a half. And since a lot of us in this room are under the age of 40, right? And we're talking about over a 20-year time period, the market has never lost, right? It's always gained over a 20-year time period. Money that you're putting into the stock market now, part of your 401k, by the time you're age 59 and a half, that's 20 years plus of compounding growth, right? That you can just see it multiplying. Here's the beauty of 401ks. Okay, this part right here. Many of your employers are going to match what you contribute. Okay, so they would say, when I worked at KPMG, they would say everything that you contribute up to like a certain dollar limit, say $5,000, we're going to match it. So if I contribute $10,000, okay, then KPMG would then add $5,000 to that 401k for me. Okay. So when you invest in the 401k, you're basically, and they're matching it, that's free money, right? So instead of, right, going back to Kylie saying, okay, I'm putting $300 away, if that's going into a 401k, her $300, and then her employer may be adding another $50 or $100 to it, right? So if you have a 401k, you want to make sure you understand what is the matching contributions that they're offering, and you want to get to a point where you can invest, where you can contribute at least that much into your 401k. Otherwise, you're losing money. Okay. It's also a lot easier because it takes the burden of us having to think about it, right? When you invest, when you do your 401k, that money automatically comes out of your paycheck. So you don't even have to budget for that, because that's not even money that you're seeing coming into your bank account. Some plans offer loans. You can take loans out of your 401k. That is highly, that's discouraged for a lot, really for this reason right here. And people make it sound like it's good. Oh, you can take out a loan and then you're just paying yourself back in interest. But if you leave that job, and we leave our jobs, right, you have to pay all that back within 90 days or 60 days or something. And the fact that you took the loan out in the first place is probably an indication that you don't have the money available to pay it back. Um, some 401ks have limited options. So because this is offered through your employer is going to decide which brokerage firm you're going to have your 401k at. And that brokerage firm may limit what your options are. So they may only say you can invest in these 100 mutual funds. So you can't go invest in the Cow mutual fund. Or you may not be able to invest in a specific stock. Okay. The IRS also has limitations on how much you can contribute. So for 2019, the maximum you can contribute is $19,000. Okay. Unless you are over the age of 50, then you can contribute more. You can contribute up to $25,000. Okay. It's called a catch-up contribution. Okay. And if you work for a government or an education institution like I do, I don't have a 401k, I have a 403b, right? Same thing. Just 401k is what 401k is. This is in the tax code, section 401, paragraph K. So we call it 401k plan because they're just calling out the chapter and verse of the IRS code. What questions do you have about 401ks?
I have a question. So the 19,000, is that a contribution between you and your employer or just you?
That's just you.
Okay, not counting the employer.
Right. Yeah.
Okay.
I have a question. Say you don't make it to like 59 and a half. Can your family like take out the money, or like what happens to the money?
Yes. So that would be part of your either in a trust or a will, or if you don't have either, in a probate. But you own that asset, and so upon your death, and this is under the age of 59, over the age of 59, upon your death, they're going to figure out what assets you have, what liabilities you have, take your assets to pay off your liabilities, and then divide the rest amongst whoever the beneficiary is, or your spouse, or your children.
Okay, thank you.
Other questions? So let's talk about IRAs. Okay. So this is another investment account. And with IRAs, there's way more opportunities for you to invest in, right? So because it's not sponsored by your employer, so you don't have those limitations that your employer may put on you. If you don't have a 401k, or if you maxed out your 401k, this is another great option, or great option for you to put your money in, because again, even though you may have to pay taxes on it on the front end, you're still getting the benefit of not having to pay taxes based on your growth. Okay. Nicholas is asking, what's your question on that, Nicholas? On the 401k?
I just need to finish writing down something really quick.
Oh, okay. I'm recording this, so you always can go back and, you don't have to listen to the whole recording. You can if you like, some say I have a soothing voice that puts people to sleep, but maybe it's the topics that I'm talking about as well. I don't know, but you can always go back and find it. I just want to make sure I get through get through all this. For IRAs, you can contribute up to $6,000. If you're over the age of 50, you can contribute up to $7,000. Okay. This continues to go up. As you can see, in 2018, it was $5,500. You don't have to pay taxes on any of your investment gains. Okay. So you're gaining money, right? And that money is then being reinvested in the marketplace, in the stock market or bonds or whatever, right? And so now it's helping to compound faster because your $50 gain is not being subject to $10 worth of tax. It's $50 that's then going back into investments. Okay. The other good thing about IRAs is, depending on your income level, you may be able to make a deduction from your taxes. Okay, so the government says if you're contributing to your IRA, you can make a deduction on your we'll deduct that from your taxes. Okay. There is a limit. If you make less than $65,000 as an individual, or $104,000 as a married couple, then all of your contributions, the whole $6,000, is tax deductible. So you don't have to pay taxes on it. However, if you make more than $75,000 as an individual, or more than $124,000 as a married couple, then you cannot deduct anything. And it starts to phase out between 65 and 75. They start phasing out what you can deduct. Oh, that's it right here. Based on your income. There's still the 59.5 that you have to reach. Okay. So keep that in mind. And I think I had, oh, here we go. So this is just repeating what I just said about the income limitations for when you can invest in an IRA. So still a good strategy, right? So if you're investing and you're investing for the long term, right? And I don't know if long term is 10 years or if it's 20, or if it's, something to get you close to your 59.5, you want to be in that IRA because now I'm avoiding paying taxes on my gains. So this is the one that people really like. This is the Roth IRA. Okay. And if you are, a younger person, lower income, or you're making less than income right now, and you qualify, basically if you qualify, this is the route to go. Okay. So here's the difference. With the Roth IRA, you do pay taxes on the front end, but once you pay taxes and you put money into this account and you start investing, you'll never pay taxes again. So I don't know what the tax rate's going to be at the age of 59.5, right? But chances are it's probably going to be more than what it is now, right? But you're taking all that uncertainty out, right? And all you're doing is just benefiting from your investments. And when you're ready to withdraw money, it's all tax free, right? So that's 20%, 30%, 10% savings that you have. You can also, once you've made your initial contribution, you can start withdrawing, okay? Because you've already paid taxes on it, so there won't be an additional penalty associated with that. What I didn't talk about with the IRAs and the 401ks is they have minimum distribution requirements. So once you reach the age of 70.5, I think it's moved up to 72, or it's moving up to 72 years old, you have to start making distributions, right? So that was to whoever was asking that question. They don't want you just having this money sitting in your 401k forever. So with Roth IRAs, though, there are restrictions. Okay. So some of this stuff shouldn't even be on here, like this bullet. But this one here, if you earn less than $124,000 a year as a single person, you're eligible for a Roth to contribute to a Roth IRA. Okay. Or if as a married couple, you're earning less than $196,000, you can contribute to a Roth IRA. Okay. If your income is as a single person is above 139,000, or as a married couple above 206,000, then you are not eligible for a Roth IRA. So the advice that Dave Ramsey, I've talked about him a lot, that Dave Ramsey and his crew gives as it relates to retirement is they say you first want to look at your 401k plan, and whatever your company is going to match, say they're going to match $3,000, then you want to contribute $3,000 to your 401k, because that $3,000 turns into $6,000 off top. Okay. And then they say you should then go invest in your Roth IRA and maximize that. The maximum on your Roth IRA is $6,000. Okay. So you want to put $3,000 in your 401k to get the match, and then if you got more money to invest, put up to $6,000 in that Roth IRA, and then if you got more money to invest, then go back and put it into your 401k up to the maximum. Okay. Questions on the Roth IRA?
What happens if, I mean, that you said that we have to make distributions of the money we have in Roth IRAs, I think, for when we get to around 70 something. How do they enforce that per se, that you have to do that?
Oh, the minimum distributions?
That's right, yeah.
Oh, because they know how old you are, and so they just start sending you checks?
Yeah.
Yeah. And then at the end of the year, you get a tax form that goes to you, that goes to the government. The government knows this is how much we're going to tax, this is how much Bryant received. Yeah.
Oh, okay.
So Jalen's asking, if I have a Roth IRA, does the account close if I make over $140,000? The answer is no. So one of the mistakes that I made as a young cat was I didn't know about Roth IRAs, didn't invest in a Roth IRA. And so now, like, I can't invest in a Roth IRA. But once you're invested in it, that's going to sit there. Okay. And it's going to continue to earn money. You can no longer contribute to it, but you're still going to benefit from all that compounding. And then when if you have a year where your income is below that 140, then bam, you're back into it. You're investing, right? And then it's above it again, and you stop investing.
And I think that's what one of my teachers was mentioning when she said Roth IRA, because I was waiting for this to be brought up, Roth IRAs, and I think she just had it pronounced differently.
Yeah, some people call it an IRA, but IRA stands for Individual Retirement Account, so it's an acronym. So,
okay.
Like, I told my daughter, who's 26, who makes less than $140,000 a year, to open up a Roth IRA and could do your 401k, right, until you hit your match, and then start opening up doing your Roth IRA. And then she didn't act on it, so I just opened up one for her. and start putting money in there enough so that she doesn't get taxed on it, and I don't get, but again, starting to contribute to her retirement plan.
You did mention this was like for young people. How old can you start an account, and how, like, what's the limit, I should say?
Yeah, so it's not, I misspoke. It's not for young people. I think the younger you are, the more opportunity you have to invest. So if you are married and between you and your husband, you make less than $206,000 a year, then you can open up a Roth IRA. It's not based on your age. It's based on your income.
So how much we have to put in your Roth IRA not to be taxed on it a year?
How much do you have to put in? You can put in as much or as little as you can afford. So $100 a month, fine. $50 a month, fine. If you're gonna invest in the stock market, you're gonna buy mutual funds, and you're thinking this is for the long term, you might as well buy these mutual funds and stocks through a Roth IRA account and avoid having to pay additional taxes on it. Other questions? All right, this is the self-employed IRA. Okay, so if you're self-employed, and if you drive Uber or Lyft, or you do DoorDash or Instacart or Amazon delivery something, right? These are all examples of being self-employed. Okay? You're a contractor. You can contribute up to 25% of your income, or up to $57,000 into a SEP, self-employed IRA. Okay. So again, works the same as the other IRAs. You're not paying taxes on it as it's. Hold on, let me make sure I'm in the right box. I think the SEP IRA is before tax. Yes, so you don't even pay taxes on it, right? So you're making money, but you're not paying taxes on it because you're putting it into an IRA account, and it is before tax. And then you don't have to pay taxes until you start withdrawing the money. So now you're thinking, all right, so I'm going to maximize my IRA, 6,000, 7,000. If I'm self-employed, I'm going to start putting a portion away, also avoid not paying taxes on it, by putting a portion away into a self-employed IRA, right? So all these different ways, if you're going to invest in the stock market, invest in bonds, all these different ways to minimize your tax liability. There's also the simple IRA. So if you're a small business owner, or you work for a company that has a small business, less than 100 employees, they can do what's called a simple IRA. Works kind of like a 401k, where the money's withdrawn from your account, and it grows tax-free. Contribution limit is $13,500. Okay. Or if you are over the age of 50, then it can be more than that, 16,000, additional $3,000. But this is another employee offered plan. Okay, so some companies aren't big enough to where a brokerage firm is going to set them up with a 401k plan that's advantageous, right, in terms of fees and options. And so this is another option that small business owners have. Questions on the SEP IRA or the simple IRA?
Yeah, can you still go for another kind of IRA even though you're self-employed?
So you can do your IRA.
Yeah.
If you're self-employed, you do your IRA, but for $6,000. But that's the limit. You can do $6,000. So if you've got $10,000 of disposable income that you want to go to your retirement fund, you can do $6,000 in the IRA, another $4,000 in this SEP IRA, or you can do all $10,000 in this SEP IRA. Then there's the Roth 401k. Okay, so this is relatively new, but again, talk to your employer to see if they offer this. This is a 401k that works like a Roth IRA. Basically, you're saying, I want to pay taxes on the money up front, but then I want it to go into this Roth 401k account, earn interest, and make gains tax free, and then like withdraw it tax free. Okay. So if your company is offering a Roth 401k, because it's not based off of your, there's not salary limitations or income limitations to it. This is an excellent opportunity. I'd rather be invested in a Roth 401k than a regular 401k. But again, not a lot of companies offer this. Questions?
More companies will be offering the Roth 401k in like the future.
Sorry, you're gonna have to start over because my internet is choppy on your voice.
I couldn't hear it either.
You want to ask again, or you can type it in the chat.
Do you think that like in the the coming future that more companies?
I think you're asking, will more companies start to offer the Roth 401k? Is that what you're asking? I'm not even sure whose voice that is. Is that Nicholas asking that question? I don't know. Yeah, I don't know. What I'd like to see more companies start doing is doing automatic 401k contributions. So right now, when you start working at a company, they give you the option to invest, and you have to tell them, do you want to invest 1%, 2%, 3%, et cetera. Where I'd like to see more companies say, welcome to the company. By the way, 3% of your salary is going directly to your 401k. And if you want to adjust it to 2%, 1%, 0%, then you can do that. I think giving us the opportunity to opt out versus opt in helps us as individuals in our retirement strategy, because now it's kind of forced on us and we have to do something to stop it versus us having to do something to start it. So then for those of you who are parents or thinking about becoming parents, this is not an investment or retirement vehicle per se, but it is an investment vehicle. and that is creating a 529 plan. Okay. So these, again, this is 529 is just a section in the IRS code. But this is funds that's used to cover educational expenses all the way from kindergarten to college. Okay. So you can start investing money or putting money into a 529 plan. And then once the money's in that bucket, you can buy stocks, mutual funds, bonds, etc. Every state is run by different states, so that each state has different rules. Some states will, so federally, you don't get a deduction on your federal taxes, but some states will give you a deduction, so you don't have to pay state tax on those amounts. Unfortunately, California is not one of them. Okay, so we don't get a tax deduction for our 529 contributions. But what some other other states do, like state of Michigan, for example, to entice people from California to invest in their 529 plan, they'll say, hey, if you invest in our plan and you do these certain things, we'll give you a $200 bonus. Okay. So it's kind of helping to cover the cost of what we have to pay in taxes. Okay. There's no specific 520 contribution limit. However, if it's more than $15,000, it may be subject to gift tax. So the person that's receiving it has to pay taxes on it. The other thing that I think is important to point out, and this is what I really like about a 529 plan, is the account can be transferred to different people, right? So for example, with my daughter, I set up a 529 plan for her to go to college. Well, let's say that she decided not to go to college, or let's say she got a full ride scholarship and didn't need the money that I'd saved for her. Well, I can then take that I can take the money in that 529 plan, that account, and just change the beneficiary and say it's no longer Kasani, now it's Makai, my son. Okay. And then let's say Makai doesn't need it. I can transfer it again, right? None of my kids need it. I can transfer it to my grandchildren. I could transfer it to my niece, right? So as long as the money's in that 529 plan, you can designate different beneficiaries and have for the money to be distributed on their behalf versus who you initially set it up for. Questions on the 529 plan?
Someone had a question in the chat.
How much is the gift tax? I believe it's taxed based on ordinary income. So if your grandparents gave you $100,000 gift, you're going to get taxed on about $85,000 of that. And I'm not sure exactly. Remember, I don't do taxes, but they can't just give you that money free and clear. There's a limit to how much they can give you every year. Because when you die, you have to pay an estate tax. So, and they want to make sure that rich people aren't avoiding that by saying, well, no, my estate's zero because I just gave all that money to my kids or my grandkids. Let's see. Other questions? Yeah, I love about when we get to, oh wait, I have one more slide I wanted to show you guys. I love when I get to this part of the class because people are like itching to like want to talk about IRAs and 401ks. But then they're like, man, this is so boring. Well, yeah. So I wanted to come back to this, right? Because when we get up here to investments, you can see a lot of it has to do with what are your goals, right? If your goal is saving for my kids' education in the next 15 years, a 529 plan is an ideal situation. If your goal is saving money for retirement, the Roth IRA or the 401k or the Roth 401k are ideal situations, right? If your goal is to save up for a car, right, your $50,000 car, well, then you don't want to be in a 529 or an IRA. You want a regular brokerage account where you can invest money that way so that you have the ability to pull that money out at your convenience. All right. That's all I got today. So next week, I believe, is our last week of class. We're going to talk about the final exam. And really, what I really want to do is answer whatever questions you all have. So if you have questions that I have not answered through this entire semester, man, put them in the chat, email them to me. Like, make me work, because I'm not going to work for 2 months. Make me work next week. All right, you all have a great weekend.